Good evening, all. This is Shay Horowitz, ShogunTrading.com. This is our weekly newsletter. Last week was one of the strangest weeks I've ever seen. There's a lot of theories why the market did what it did. We had a ton of negative news for the market, all the way from cap and trade to the healthcare to bankruptcies to delinquencies on credit cards to delinquencies on mortgages to higher taxes. Whatever you want to think about, it was bad news for the market. And the market knows about the bad news. And the market went into a downtrend. Here's a shoulder, here's another shoulder, shoulder, head, shoulder, and you can see how we broke the neckline and we came down. We were below all moving averages. Everything was looking great for the short side. Everyone was ready for the short side. Everyone was ready to jump on the market. And that's why the market rallied. The market rallied because of a short covering rally. On Monday morning, Meredith Whitney, which is a very big analyst that was very, very bearish about the banks, said that, she thinks the banks are going to come up. And why are the banks going to come up? Because the banks are now able to borrow for zero. They're able to invest their money, and they're able to charge higher rates for customers. They're not loaning money out, but they're using their cash to pay down debt, and they're using their cash to buy other banks, and they're using their cash to invest. Why would they lend money out when they can invest it for so much better returns? And that's basically what they were doing. The market, that's how they made their money. Let's put it this way. We are going to look at bonds, and here's the 20-plus year bonds. And this is something that banks can invest in. The yields are pretty high. The yields are going to come, in my opinion, going to come back up to the 4%. And the banks have a choice. The banks are able to buy money, because they're buying money from the feds, for 0%. And they're able to buy bonds, short-term bonds. They're able to buy short-term bonds for near 3%, 4%. I forget exactly what the yield is. It changes every day. But between 3% and 4%, that's basically the range we're at. Now, if you were able to borrow money for zero, basically, and then lend it back to the government for 3.5% or so, you would do that all day long. Why would you give someone a mortgage for 4.25% if you could just get secured funds back from the government for higher rates? And that's basically the competition that's going on right now between the investment in government bonds, which is going up, to mortgages. And that's why they're not lending their money out. They're investing their money. They're making very, very secure, high margin profits. And that's what drove the market up. The other thing that drove the market up are the semiconductors. Semiconductors, led by Intel, are cutting back their expenses, and the sales are actually going up because of the stimulus in China. China is the one that's leading the charge right now on the global expansion. Their stimulus plan really, really worked. And you can see how semiconductors broke out to the upside. That's basically where growth came from. If you look at S&P 500, we are almost at resistance. If you look at INDU, which is Dow Jones Industrial Average, we're almost at resistance to 88.39. But the one that really, really broke out is the NDX, the Nasdaq 100, which of course is very tech rich. Lots of earnings last week. Goldman Sachs, Intel, IBM, GE, JP Morgan, Bank of America, Citibank, or say Google. Their earnings were not all that. I mean, yeah, they beat estimates, but the estimates were so low that they beat them, yes. And they beat them through cost cutting. Cost cutting is not a long-term strategy. Growth is long-term strategy. So the fact that the market went up last week was basically short covering rally, especially the fact that it was an options expiration. Options expiration happened on Friday. So people had to come in and cover quickly. Now, the figures on the market were extremely strange last week. For example, VIX, which is the volatility index, which is usually inverse to the market itself, was actually going up while the market itself was going up, which means scared was going up as the market was being bullish. Even stranger than that, the down volume on most days, on some days, was triple the volume of the up volume, Down volume, triple the up volume on an up day, which was very, very strange. Basically, you had a lot of people covering their shorts quickly. Now, I have to say a couple of things that might sound like a conspiracy theory, but I have to say them anyway. On Monday morning, right here, all of a sudden our ECNs were down. ARCA and NYSE were down. We were not able to execute trades on ECNs. Stranger was the activity in the futures market. The futures market was up big. We saw some tremendous buying, serious size buying. Somebody knew something, and that's what caused the short squeeze. Short squeeze, basically people that were short or short calls had to go in and buy calls and buy stocks in order to cover their short positions, and that's what happened. Now, is this going to last forever? How long is this going to last? I don't think it's going to maintain. It's got to be a certain driving force behind the market. It's got to be a real reason behind the market. And I don't think that this week is an indication of what's going to happen. We have to wait to see after options expiration, after this kind of a strange short covering week, what's going to happen. We'll have to see. There's a couple of things that I want to show you. One of them is gold. Gold was going to break the 88.76. This is GLD, by the way. I'm not talking about gold itself. I'm talking about the ETF. Was supposed to break the support and instead came back up. It still could break support. SLV is already in a downtrend and coming down. It could accelerate on the way down. USO, which is the oil ETF, bounced off the support that I gave you, the 31.49, and coming back up. So oil is coming back up. Gold and silver are coming back down. Here's the dollar. The dollar itself, zoom out a little bit, and you can see the dollar itself is breaking support. Where's the dollar going? The dollar's going down. And here is the euro. Notice that the euro is really close to penetrating resistance. That's 142. This could be a very, very interesting trade if the euro penetrates the 142 while the dollar itself is penetrating the 79.53. Dollar's going to go down, and the EU, the euro, is going to go back up. That's a pretty interesting trade. If you are a futures currency trader, that's definitely something that you want to look at. Our Japanese yen did extremely well, came back down. I think it's going to come back up. So I think Japanese yen and euro are going to come back up, while I think that the dollar itself is going to come back down. A couple other ones I want to show you. This is Shai. This is the iShares 1, 2, 3. And it's coming back down. This is the 7 to 10 coming back down, and this is the 20 plus that's also coming back down. This is a dangerous sign for us. This is not a good thing for us. As bond prices come down, yields go up. As yields go up, mortgages are going to go up, and that's going to put a squeeze on the mortgage market and going to slow down the real estate market even more. So that's definitely something that you want to pay attention to. Anyway, last week smelled funny to me. It smelled funny. It did not make much sense. It was a short squeeze week. It was based on options expiration week. A lot of people got caught short. Our guys did not, because we took advantage of the short. We took advantage of the downtrend right over here, and I told everyone to cover right here. So we covered right before the rise. Now what we're waiting for it to set up something so we can take the next trend. Whenever I see the next trend, I will let you know. For a daily update, you have to sign up for the daily newsletter. For a weekly update, you're on the right newsletter. Have a great night and have a great week. Take care.